Konnichiwa. My name is Vinay Thopper, Co-Chief Investment Officer for U.S. Growth Equities at AllianceBernstein. It's a pleasure to be with you here today to talk to you about the U.S. equity markets and performance of the American Growth Fund. The market has been quite resilient despite valuations resetting a bit, as you can see on the left-hand side. We remain encouraged by the projected earnings growth, as you can see on the right-hand side. In fact, if these estimates come to fruition, the next 2 years will be among the strongest years for earnings growth that the S&P has seen in quite some time. Much of this growth has been driven by the growth of AI through semiconductor and data center companies. As you can see over the last 1 year, high growth speculative stocks and high beta stocks have meaningfully outperformed quality stocks. Our portfolio looks for high quality businesses that can generate high profits and create durable growth at attractive valuations. This focus on profitability has been a headwind in the near term, though longer term we remain quite confident in its ability to continue to generate alpha for clients. Quality today is among the cheapest it has been in quite some time. In fact, the last 2 years, the quality factor has been in the bottom quintile of performance. In our view, this sets up for a favorable return profile over the medium to long term. As you can see on this chart, U.S. quality companies are cheaper than many other sectors in the market, including the U.S. NASDAQ, as well as IT companies. The past 1 year in performance has been disappointing. Again, this is largely due to the underperformance of the quality factor. As we look out over the historical term, performance was quite good. So while we are disappointed with the performance over the last 1 year, it is important to keep in mind that the fund has only had 3 negative years over the last roughly 13 years, and the magnitude of underperformance over this past year is in line with historical results. Longer term, we remain quite convicted in the philosophy and process. We continue to execute a disciplined construction strategy and have made no changes in the types of businesses we look for. This shows the attribution over the prior 1 year. What you can see is that industrials, healthcare, and consumer discretionary were meaningful detractors to performance. In particular, industrial companies enjoyed strong performance as many cyclical businesses have received investor attention due to the promise of AI. We believe that investors need to be cautious in selecting such businesses, as there is inherent cyclicality in these businesses, and earnings growth today may not translate into durable profitability over the medium to long term. Healthcare has been a disappointing sector for the last few years, as investors have sought out more riskier securities and policy concerns have outweighed strong fundamentals. The healthcare sector today is at nearly a 20-year low on valuations and nearly a 30-year low in terms of its weight in the S&P index. We believe both of these characteristics suggest attractive opportunities for long-term patient investors, as profitability remains quite good and long-term earnings growth potential we think is quite strong, driven by innovation and what we believe will be benefits due to AI. The consumer discretionary sector has underperformed as investors have grown increasingly concerned about the impact of the economy on consumer spending. We believe investors need to be specific here in how they allocate capital to the sector, and our holdings, we believe, will be quite resilient despite concerns around consumer spending. Here you can see the portfolio activity, and what I would call out specifically is the right-hand side, where we introduced GE Industrial into the portfolio, which is a company that derives a majority of its revenue through aftermarket servicing of its jet engines. We believe that backlogs remain long for GE, providing durable revenue growth and high levels of profitability. In addition, GE also provides propulsion systems for the military, which we expect will increase in spending as the U.S. continues to aggressively spend on defense budgets. Let me talk about a few of the transactions that we executed during the quarter. AI has clearly created a lot of disruption and concern among investors, particularly in the software sector. Our belief is that certain software companies will be better protected and in fact benefit from AI, while others are indeed at risk of being disintermediated. In particular, vertical software companies that provide software to very specific industries with high levels of regulatory and compliance burdens will be better insulated from AI disruption. While horizontal software companies, companies that provide software that are used by many customers and that don't provide clear benefits, are more at risk from AI disruption. As an example, Viva is one company that we expect will benefit from AI. Viva is a healthcare IT company that collects data for pharmaceutical companies, enabling them to submit these data to regulatory agencies in an electronic way. In our view, it will be very difficult for AI to disrupt Viva, as these are core systems of record for pharmaceutical companies, and removing them or adjusting them introduces significant regulatory risk for pharmaceutical companies. Viva is a very profitable business that generates returns on invested capital in the low teens. It's very well capitalized, with nearly 25% of its market cap now in net cash. The founder of the business owns nearly 8% of the company, and its growth rate has been quite good in the low double digits. So we continue to like a company such as Viva for its competitive positioning, competitive advantage, difficult ability to disrupt, and most importantly, attractive profitability and valuation. Conversely, a company like Intuit, we think, may be more at risk from AI disruption, as large language models could over time take over the job of submitting tax forms to regulatory agencies in the US. As such, a horizontal software company like Intuit, we think, is at more risk of disruption than a company like Viva. So in conclusion, while performance over the last year has not met our standards, much of it is due to the types of companies we look for, namely high-quality businesses, whereas the market has recently chosen to reward high-growing speculative companies or high-beta companies. Over the long term, the data and the performance of the strategy has shown that sticking with high-profitable companies tends to generate strong client outcomes and returns. So we remain convicted in the strategy. We continue to execute a disciplined philosophy and process, and would note that while disappointing over the last 1 year, it is entirely within the historical range of underperformance that we have witnessed in the past, of which there have only been 3 in total over the last roughly 13 years. Thank you very much for your continued support and interest.